Hey everyone, it's Daniel here from Infravest. Hope you're all doing well. I actually have the speech and a couple of scribble marks here on Jerome Powell's speech that he did yesterday, and on the inflation and the labor market. So basically, Jerome Powell came out yesterday and said a couple of things that really moved the markets. And what we see since today, and actually since yesterday, after Jerome Powell came out, we saw stocks, bonds, gold, all these markets really rally. Bitcoin, crypto as well, all all day rally yesterday, and also we see bonds today rallying, where you see the yields come off just because of a couple of things that Jerome Powell said. Now, I'll go through the speech, but I'm just going to first summarize what happened. So, the biggest thing that people were waiting for in Jerome Powell's speech was they were anticipating some sort of hawkishness to come out. Similar to Jackson Hole, where Jerome Powell came out and said things that was very hawkish in terms of hiking rates to very aggressive levels. Now, they didn't really receive that in yesterday's speech, in yesterday's meeting, in yesterday's Q&A, right? Jerome Powell came off more on the dovish side, which caused equities and bonds to move up and the yields to come down, and for the terminal rate now being priced in a little bit below 5%. And we also saw the yield curve basically steepen a bit more, basically anticipating that a slowdown in rate hikes are probably going to come and show up very soon. So the markets took it in a very, very positive way, right? The markets rallied, the equity markets rallied, and including the bond markets as well. And the biggest kicker that I would say, the comment that Jerome Powell mentioned, is that he said he does not want to over tighten. That was the biggest, right? The fact that he came out and said he didn't want to over tighten, that caused equity markets, bond markets to even rally even more, pricing in that this pivot is finally coming, right? This pivot in 2023, where they're going to pause rates or maybe even start cutting, is likely to come. Now, was that the right move after the few comments that Jerome Powell mentioned? I mean, we know and we have heard Jerome Powell say that the pace of the rate hikes are going to slow down. But the level, the terminal rate level, we still don't know where that level is. We're still going to hike, we're still going to raise rates, but we don't know where that level is and where we're headed towards in terms of interest rates, right? But we're definitely still hiking rates in December. He mentioned also 50 basis points is what he's expecting to do, which also caused markets to rally. And basically that 75 basis point, that pricing in of 75 basis point, those odds basically came down, and it's more kind of confirmed that we're going to get 50, and then next year it's going to be 25 and onwards, but at a slower pace. We're still raising rates, but at a slower pace. Now, what does this mean, right? What does this mean in terms of 2023? Well, if you look at data, especially this week, ADP employment, we had ISM manufacturing that came out today as well, weaker than expected. Chicago PMI coming very weak, giving recessionary signals. Same with the ISM manufacturing. PCE, core PCE coming in lower than expected, showing weakness in prices. ISM prices coming weaker than expected. And we have non-farm payrolls tomorrow, which is looking like likely it's also going to show some weak data as well. And to top it off, the cherry on top this week was Powell. That came in with the dovish comments saying that, okay, we're seeing growth kind of slow down. We're seeing, signs of falling in economic growth, bottlenecks in goods production easing, and so on. And we're seeing some leading indicators where prices are somewhat coming off. And that's why, we can slow down our pace of our rate hikes, but we're not done, right? And that sense of not doing more, that sense of not getting very aggressive with rate hikes, the fact that he also mentioned that, we're not going to get this massive flow of higher rate hikes, but we're still moving up higher, and the fact that he doesn't want to over tighten, and the fact that also he is selling the idea of a soft landing is what got the markets, rallying like yesterday and today. Now, going through the speech, the first paragraph, Jerome Powell basically acknowledges, very first off the bat, acknowledges high inflation. Okay? He says that without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve sustained period of strong labor market conditions that benefit all. And also acknowledges the reality that inflation remains far too high. He also says, by any standard, inflation remains much too high. Much too high. And sorry, let me read that line again. It will take substantially more evidence to give comfort that inflation is actually declining. By any standard, inflation remains much too high. So in the first two paragraphs, basically saying that, I understand inflation is high. Understand that, we cannot just let inflation go all of a sudden. We have to continue with the hiking. And if we look at also another comment that Jerome Powell says here, these are, while October inflation data received so far showed welcome surprise to the downside, these are single months data which followed upside surprises over the previous 2 months. So basically, they're saying that, we still need more data, although we did see some surprise with the inflation data. We still need to continue to look at more data, and they're not done. The job is not done. Now, if I go on the second page here, he also mentions in another paragraph that for starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. So what does that mean? The current rates that we're seeing right now is not restrictive. What is sufficiently restrictive? I thought we were in restrictive area, which, they mentioned sometimes before. They also mentioned that, as our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that ultimate level of rates will need to somewhat be somewhat higher than thought at the time of September's meeting and summary of economic projections. I will return to policy at the end of my comments, but for now, I will simply say that we have more ground to cover. So, okay, we still need to get to restrictive territory. We still have a lot of ground to cover. We're still raising rates. Why did the equity and bond market rally? Well, they rallied because we're not going as aggressive as we did in 2022. And on top of that, we are slowing the pace. And Powell mentioned he doesn't want to over tighten. The data's getting weak, like he mentioned, and looks like things are getting better. So that's why equities all of a sudden had this massive squeeze. And bonds also started rallying as well. Now, I would say bonds, the rally we're seeing today especially, yes, has to do with prices coming down, but also weak data, right? Recessionary vibes. We can see bonds go up on recessionary feelings, right? Recessionary sentiment. If the bond market sees that next year you're going to get very ugly numbers in terms of growth, then sure, bond market will rally. And if they get the rate cuts that you know, the markets are expecting, then sure, you will see the bond market definitely rally. Now, another paragraph here that despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it is useful to break core inflation into three component categories, which are core goods inflation, housing services inflation, inflation in core services other than housing. So I'll let you guys read those paragraphs, but he basically, what Jerome Powell does is he breaks down the core inflation in these three categories, says that core goods inflation has moved down from very high levels over the course of 2022. However, services, housing inflation, and inflation in core services other than housing, that we have seen it rise quite a bit, right? Quite rapidly, especially when it comes to rent. Rent has continued to increase. So he's anticipating that hopefully next year that will come down. And also the core services other than housing, those things will also come down. And then he points towards the reason why it's elevated. It has to do with jobs, right? And wages, really. Wages, which is because of the job issue that's happening, right? So he mentions that, okay, the elderly people that are there during the COVID time, who were not supposed to retire, actually ended up retiring because one, their retirement investment accounts did very well after 3 months of dropping. Obviously, after a year, after 2020, markets went up 100%. Plus, on top of that, the elderly who have retired and decide to all of a sudden retire are not coming back to the labor force. And a lot of them decide to do that because of concerns of COVID and health issues. Another thing that he mentioned was also that the working age population, a lot of them have seen a lot of deaths, which also is the contribution to the labor market not being kind of tight, where you're seeing a lot of employers looking in certain areas, right? Not in tech, but in certain areas, but the labor market looking for workers, and they just simply can't find them. Now, you can argue anything about the real reasons. It could be that we are in a new era, digital era for the working age. It could be that people moved out, found other jobs, or they're still getting, EI insurance or stimulus money or whatnot. You can argue a whole bunch of things, but the point is that due to the labor shortage, this is what caused wages to go up. So his answer was that, again, in his report, saying that because wages make up large cost in delivering these services, the labor market holds the key to understanding inflation in this category. In other words, kind of kill the jobs, you'll bring wages to normal levels. And wages have been going up too much because of these such issues. Now, let's see, what else did he mention here? Fast forward a couple of pages. So sums up at the end, and there are also some graphs for you to look at. And again, I'll post a link in the comment section. Basically sums up the last couple paragraphs, saying that we'll probably keep rising well into next year, but inflation on new leases continues to fall. We're likely to see housing services inflation begin to fall next year. Shows only tentative signs. Finally, the labor market, which is especially important for inflation in core services, ex housing, shows only tentative signs of rebalancing, like I was saying before. And wage growth remains well above levels that would be consistent with 2% inflation over time. Despite some promising developments, we still have a long way to go to restoring price stability. And then monetary policy affects the economy and inflation with uncertain lag. So he acknowledges that some of this data is also lagging. And the full effects of our rapid tightening so far has yet to be felt, right? All the 2022 tightening that has been done, we're going to see it definitely in 2023, especially in the data, right? Especially in that growth data that is yet to come. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. Again, what's that level of restraint? Hasn't really told us that. Given our progress in tightening policy, the timing, the moderation is far less significant than the questions of how much further we will need to raise rates to control inflation. History History cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So really, when I go through this whole thing, yes, you could argue we're slowing down the pace. We know that. They've said that before, right? But right here in the speech itself is telling you that they're still continuing with rates. They still will continue to jab at the market. Maybe not as hard as what they've been doing in 2022, but they will continue to jab by raising rates at a slower pace, by doing it maybe 25 basis point increments, and then kind of see what happens from there. And they don't know where the restrictive area is. We heard Bullard long ago talk about that 5 to 7%, probably 7%, if we follow the Taylor rule to get rates above inflation, 7 to 8%. If inflation is around 7 or 6% down the road, then that Taylor rule would suggest that yes, you can bring inflation down. But if we bring rates at very high levels, then sure, something will break. And when the economy breaks, whenever that is, then definitely you can get inflation down. You can get those job losses, those wages to come down, goods of prices to come down, demand crunch and so on, which will basically bring prices lower. So sure, is that possible? Yeah, it can happen. But the speech itself, when I read through it, and how the markets reacted, I think the markets definitely overreacted to this, again, dovish pivot, and they keep doing that. And it's a sign. I'm like, don't fight it, right? Don't fight the equity markets, right? Because it could be very, it could go the very, wrong way for you if you try to short this market. But don't fight it if they want to get high off of just one little two comments. It's just showing you signs of how much the equity market is tired of the sell-off and is waiting for anything like a simple comment like the Fed saying he doesn't want to over-tighten. But we're not done. We're not done with raising rates. We're not done with Powell bringing inflation down. So the fact that he's going from not aggressive rate hike pace to this 25 basis point slow pace next year is just saying that, hey, we don't want to start loosening policies because history suggests us not to do so. So we will keep jabbing and then jab, and see where we are in the economy. And once something really starts to break, then they'll probably stop jabbing. Another thing I want to mention also during the Q&A, someone mentioned about the policy that they introduced during COVID or pre-COVID about the AIT, the average inflation target. And Jerome Powell basically said that he's going to continue with that framework, which no one is talking about, which is really crazy. So basically, average inflation target back in 2020 the goal was to bring inflation high by having inflation repeatedly at high levels to get the average higher. So what does that mean for 2023 and onwards? That means to bring average inflation target down, the average inflation, you need repeatedly low, maybe negative inflation, a couple of negative inflation to bring that level down to 2% or below, right? So that's what it suggests. So to do that, again, has to do with the economy basically getting into a very severe recession. So let's see. This is just my takes from reading the speech. I'll leave the link below in the description, and comment below if you have any questions or any comments and what you guys think about this whole speech and the markets rallying yesterday and today. Subscribe, hit the like button as well, and I'll talk to you guys later. Cheers. Bye.